From the AlgoIndex trading desk, this is the market close for Thursday, the 20th of August. Here is the puzzle the closing bell left on the table. The S&P settled 1 point above the exact strike that tomorrow's monthly expiration pulls the hardest toward, the kind of print a calm, pinned market leaves behind. And on that very same afternoon, the fear gauge leapt close to 8%, back over 16, and the desks that hedge this index reached for about $10 billion of downside protection. A calm market does not pay up for $10 billion of insurance. What reconciles the two is not any number on the scoreboard. It is a line the dealers drew for themselves, and today's close finished on the wrong side of it. Stay with me for 3, and I will run them from the back. Number 3. The one headline that lifted this market at 11 and could not hold it. Number 2. Where that $10 billion in protection was actually aimed, because the dates on it say far more than the size. And number 1. The single line this market reclaimed on Wednesday and gave right back today, the line that decides how tomorrow's expiration breaks. Here are the closing numbers. The broad index settled at 7,641, down not quite 0.9%. And it closed a hair off the session low, so there was no late bounce to soften it. The Nasdaq 100 fell about 0.7%. The single heaviest weight was one large retailer that dropped roughly 9% on soft sales, its worst day since 2022. And here's the mismatch that runs through the whole night. The fear gauge did not drift. It jumped close to 8% and closed back above 16. On a day the index itself gave up less than 0.9%. A modest down day on the surface, and a real deliberate bid for protection underneath it. So walk the day itself, because it moved in 3 acts. It opened lower, following through on a sharply weaker pre-market, and the reason was in the morning data. A regional factory survey came in far hotter than expected, while weekly jobless claims stayed low. So the 10-year yield rose, and equities took it as a reason to step back. Add the retailer down 9%, and the first 2 hours were a giveback with a cause behind it. Then, at 11 came the one real attempt to turn it. A headline crossed that the Treasury might expand its buybacks of longer-dated debt, and that yields do not reflect the fundamentals. For 20 minutes, that was enough. Price ran up to the high of the day, 7,700, almost to the tick. And then it stalled. It could not clear the round number. The bid drained away, and from there the afternoon was one long, orderly slide, closing at the low. One hot data print, one hopeful headline that failed at a round number, and a settle on the worst level of the session. Now, the part the closing prices leave out. Underneath that modest decline, the hedging on the index itself was anything but modest. Real-time index hedging finished the day around negative $10 billion, and the size is only half of what makes it matter. The other half is the calendar on it. Roughly half of that $10 billion was longer-dated put buying, protection dated past tomorrow's expiration, out toward the semiconductor earnings and the central bank meeting later this month. That is patient, deliberate downside cover, not a one-day flinch. On the technology side, the flow ran the opposite way, and it is telling. Longer-dated call selling across the chip and memory names, the group giving back its upside rather than reaching for insurance. And the same-day selling in the Nasdaq ran in a straight line after 2 in the afternoon, the fingerprint of systematic, machine-driven flow, not a person changing his mind. Put it together, and it is one posture: sell the near-term upside, and pay up for downside cover dated into the events that decide the rest of the month. And now the map. And tonight, it is a real one, because we captured the full 5-minute record of the session, every bar of it. Watch the shape it draws, because the shape is the argument. Price opened near 7,690 and spent the late morning leaning on 7,700. At 11 it tagged its high, 7,699 and change, one tick shy of the round number, on that buyback headline, and it failed right there. From that failure, it did not chop sideways, it distributed. A stair-step decline through the afternoon that gave way through one line after another. Here's the one that matters most. There are 2 levels beneath the market that dealers actually defend. The higher one, at 7,663, is where their hedging flips from softening moves to amplifying them. By the middle of the afternoon, price had cut straight down through it. The lower one, the control line, at 7,650, gave way in the final hour, and the market closed beneath both of them at 7,641, giving back in a single session the reclaim of that line Wednesday had just posted, and dropping onto the amplifying side of it. Now set that against one more number. Tomorrow's monthly expiration pulls the hardest towards 7,640, 1 point under tonight's close. So the market is fastened to its expiration magnet and sitting below the level where dealer support ends at the very same time. And the large dealer position that cushioned every move today, that kept this an orderly slide instead of a rout, expires tomorrow. What tonight cannot tell you is which way that resolves. The pin can simply hold the morning and go nowhere. The one thing today's data does settle is that the cushion which kept the session orderly is gone by the afternoon. Now to our own book, and I am not going to dress it up. Today was a red session for the desk, and here's the shape of it. 6 single leg looks, every one of them closed flat by the bell. Nothing carried into the expiration. The morning was the hardest kind of session to work. A two-sided grind wedged between the round number overhead and the pivot beneath, with no clean direction to lean on, and most of the looks ended up on the wrong side of it. The one that paid was a downside put in the early afternoon, carried to a defined target as the market rolled lower. 1 win, 5 losses, and a book flat into the close. On a day the map itself called two-sided and then bearish into the bell, the result was a loss, and we put the losses in front of you the same as the wins. One look back before the look ahead. Last night the lean from this desk was neutral, a shade constructive, and it rested entirely on the market reclaiming one line up at 7,720. That never happened. The hot factory data we named as the thing that could flip it came in hot, yields climbed, and price spent the whole session under that line before closing beneath the dealer line as well. The caution in that call earned its keep. The constructive side never got its trigger. To Friday, and it is a monthly expiration, which changes the character of the day. The bias is bearish, but it is conditional on the mechanics. Start with the pin. Tomorrow's largest concentration of open interest sits at 7,640, 1 point under tonight's close. So the opening hour may simply sit near it, while the morning settlement runs its course. The 2 lines to watch are the ones the market lost today. The control pivot at 7,650, and the dealer line at 7,663. Reclaim and hold above that dealer line, and the read flips constructive, back towards 7,700 and the inflection at 7,725. The likelier path is the other one. Lose 7,620 once the pin releases, and the door opens to 7,600, then the deeper support down near 7,500, and it opens more easily than usual, because the long dealer position that steadied today rolls off at this very expiration. There is almost nothing on the economic calendar to argue with it. One set of business surveys at 9:45 in the morning, and little else, so the expiration mechanics are the event. The pin holds the morning, the information is in the afternoon, once the steadying position is gone. Further out, keep the bigger dates in view. Next Wednesday brings a personal spending inflation reading alongside a marquee chip earnings report, and the central bank meeting follows the days after. This is a night to respect the pin and watch the line. One thing before we close. Every evening on this show, I read out the exact lines the dealers are defending. The flip, the pivot, the pin. If you want to see whether those calls actually hold up, session after session, held or broken, that running scorecard is open to anyone at algoindex.com/tools/gamma-level-accuracy. The written version of tonight and the free trading journal are both on the card beside me. That is the close for Thursday. The market spent today pinned to a magnet. It is now sitting just beneath, and tomorrow's expiration decides whether the pin holds or the line gives way.